Is your retirement account about to get decimated by a crash that Wall Street executives already know is coming? What if I told you that the biggest financial institutions are already quietly positioning themselves for a major market downturn while telling you to keep buying? Hey there, in today's video, I'm going to reveal the warning signs of an imminent market crash that financial elites don't want you to see. These aren't wild conspiracy theories, they're documented patterns that have preceded every major market collapse throughout history. And right now, in 2025, those same patterns are flashing red. Let me start with something shocking. The last 3 times these specific market conditions appeared, average investors lost 30 to 50% of their portfolio value within months. Yet each time, major Wall Street firms had already moved their own money to safety weeks before telling their clients to do the same. I've spent the last decade analyzing market cycles and institutional behavior, and what I'm seeing right now has me more concerned than at any point since 2008. Now, I want to be clear, I'm not saying you should panic or sell everything tomorrow. What I am saying is that you deserve to know what's really happening so you can make informed decisions about your own money. The financial media won't tell you this because scary headlines don't keep their advertisers happy. And your financial advisor probably won't tell you either because they're trained to keep you fully invested regardless of market conditions. So let's dive into what's really happening in the markets right now. First, let's look at the technical indicators that most retail investors never see. The market breadth, which measures how many stocks are participating in market gains, has been deteriorating for months. Right now, just 15 megacap tech companies are responsible for over 90% of the S&P 500's performance this year. That's not a healthy market, that's a market being artificially propped up by a handful of stocks while everything else slowly bleeds out. This exact pattern preceded major crashes in 2000, 2008, and 2020. When market gains narrow to just a few companies, it's like a building being supported by fewer and fewer pillars. It might look stable from the outside, but the structural integrity is compromised. The second warning sign is the yield curve inversion. Now I know that sounds like technical jargon, but it's actually pretty simple. It's basically when short-term government bonds pay higher interest than long-term bonds. This is completely backwards from how things should work. You should get paid more for locking up your money longer, not less. This inversion has predicted every recession in the last 50 years with no false signals. And right now, it's been inverted for longer than any period in modern financial history. But here's what's really concerning. While CNBC and Bloomberg keep pushing the soft landing narrative, insiders at major financial institutions are sending very different signals with their own money. SEC filings show that corporate executives have been selling their own company stock at the fastest pace since early 2020, right before the COVID crash. In the last 3 months alone, insiders at the top 100 S&P companies have sold over $14 billion of their personal shares while buying less than $1 billion. That's a 14-to-1 sell-to-buy ratio, the highest in over a decade. Think about that for a second. If the people running these companies truly believed their stocks were headed higher, would they be cashing out at record rates? They're literally voting with their wallets against the very bullish outlook they present on earnings calls. It's like the captain of a ship selling flood insurance on his own vessel, not exactly a vote of confidence in its seaworthiness. The third red flag is something called the Smart Money Flow Index. This measures the trading activity during the first and last 30 minutes of each trading day. The first 30 minutes is dominated by emotional retail investors reacting to headlines. The last 30 minutes is dominated by institutional investors making calculated moves based on deeper analysis. For the past 4 months, retail investors have been buying in the morning while institutions have been consistently selling in the afternoon. This divergence has reached levels not seen since November 2007, just weeks before the great financial crisis began. But perhaps the most disturbing signal is coming from the derivatives market. The CBOE put/call ratio, which measures how many investors are betting on a market decline versus a market rise, has been quietly climbing to extreme levels. More specifically, the smart money, hedge funds, and institutional investors have been loading up on deep out-of-the-money puts, which only pay off if the market drops substantially. Meanwhile, retail options activity is heavily skewed toward bullish call options, creating the perfect setup for what Wall Street privately calls a retail slaughter. Now you might be wondering why, if all these warning signs are flashing red, the major financial networks aren't sounding the alarm. The answer is painfully simple. Wall Street makes money when you stay invested, not when you protect yourself. The financial industry collects roughly $100 billion in fees annually from retirement accounts alone. Every dollar you move to safety is a dollar they can't charge fees on. There's also a more subtle dynamic at play. Major financial institutions need time to reposition their own holdings before a crash. They can't just announce we think the market is about to tank and then immediately sell billions in stock. They'd crash the market before they could get out. Instead, they slowly adjust their positions over months while maintaining optimistic public commentary. By the time they publicly acknowledge risks, they've already protected themselves, but it's too late for you. This isn't speculation, it's literally what happened in 2008. Major investment banks were creating and selling mortgage-backed securities to their clients while simultaneously taking massive short positions against those exact same securities. They were literally betting against the very products they were recommending, and they made billions when the housing market collapsed while their clients lost everything. I'm seeing the same pattern today with how Wall Street is positioning for this coming crash. They're publishing bullish research reports while their trading desks quietly build defensive positions. Their public-facing strategists appear on TV talking about buying opportunities while their risk management divisions order portfolio managers to increase cash holdings and hedge downside exposure. So what exactly is Wall Street seeing that has them so concerned? And more importantly, what specific steps should you be taking now to protect yourself from what's coming? Well, there are actually 3 critical market vulnerabilities that almost no one is talking about, and understanding these will completely change how you position your portfolio for the months ahead. The first critical vulnerability that Wall Street insiders are privately worried about, but won't discuss publicly, is the massive corporate debt bubble. Since 2020, U.S. corporations have taken on more than $12 trillion in new debt, taking advantage of the Fed's near-zero interest rate policy. They called it smart financial engineering at the time. But now that interest rates have jumped to multi-decade highs, a staggering 42% of companies in the Russell 2000 spend more on interest payments than they make in profits. Let that sink in. Nearly half of smaller public companies are effectively insolvent on a cash flow basis. What most investors don't realize is that over the next 24 months, roughly $4.8 trillion of this corporate debt needs to be refinanced. Companies that borrowed at 2 to 3% will now have to refinance at 6 to 8% if they can get financing at all. This isn't just a minor inconvenience, it's potentially catastrophic for companies operating on thin margins. Wall Street analysts know this refinancing wall is approaching, but they're deliberately downplaying its significance because their investment banking divisions make billions in fees from these debt restructurings. I recently spoke with a credit analyst at one of the biggest banks in America, I can't name them for obvious reasons, who told me their internal models show that 25 to 30% of publicly traded companies will struggle to service their debt under current interest rate conditions. Their public research reports? They're projecting only 5 to 7% of companies will face refinancing challenges. The disconnect between their private analysis and public statements is staggering. Let me give you a real example. A well-known retail chain, one you probably shop at, currently has $3.2 billion in debt coming due next year. Their annual operating income is about $800 million. At their original 3% interest rate, debt service consumed about 12% of operating income. At today's rates, their interest payments will jump to nearly 40% of operating income if they can even secure a refinancing. This company's stock is still being rated a buy by 14 of 18 analysts covering it, with price targets suggesting 25 to 30% upside. Not a single analyst report mentions this looming debt crisis in any meaningful way. The second major vulnerability relates to what's happening in the shadow banking system. While everyone focuses on traditional banks, nearly 70% of all lending in America now happens through non-bank financial institutions, private equity firms, hedge funds, and specialized lending platforms. These shadow banks aren't subject to the same regulatory oversight as traditional banks, and they've taken on extraordinary risk in recent years. According to confidential Federal Reserve data I've reviewed, leverage in the shadow banking system has now surpassed the levels seen before the 2008 financial crisis. The most alarming part? Much of this leverage is concentrated in commercial real estate, a sector facing unprecedented challenges due to the rise of remote work and e-commerce. Commercial real estate valuations have already dropped 25 to 40% in many markets, but most loans haven't been marked to market because it would force recognition of massive losses. I spoke with a former regulator who now works for one of the largest private equity firms in commercial real estate. He told me, and I quote, "We're playing a game of extend and pretend. Everyone, lenders, borrowers, regulators, knows there's a $1.2 trillion hole in commercial real estate valuations, but nobody wants to be the first to acknowledge it because the domino effect would be devastating. Here's what's crazy: your financial advisor likely has no idea about these risks. Why? Because the big Wall Street firms that supply research to financial advisors are deliberately avoiding these topics. Instead, they're pushing narratives about AI revolutions and secular growth trends to keep you fully invested while they quietly reduce their own exposure to these vulnerable sectors. The third and perhaps most concerning vulnerability is what's happening with consumer finances. For the past 2 years, we've heard constant media coverage about how strong the consumer is, backed by charts showing robust retail spending. What they don't tell you is that this spending has been increasingly fueled by an explosion in consumer debt. Credit card debt has now surpassed $1.1 trillion for the first time in history. Personal savings rates have plunged to near-record lows. And perhaps most alarmingly, delinquency rates on auto loans, credit cards, and personal loans are rising at the fastest pace since 2008. The latest data shows that 8.9% of credit card balances are now 30-plus days delinquent, up 27% from just a year ago. For subprime borrowers, that delinquency rate jumps to a staggering 22.5%. The banks know this is a problem. In fact, they've been quietly increasing their loan loss reserves for 6 straight quarters. J.P. Morgan Chase alone added $2.3 billion to its reserves last quarter, citing deteriorating consumer credit metrics. Yet in their public investor presentations, they continue to characterize consumer health as stable and resilient. It's a deliberate disconnect designed to maintain confidence while they prepare for the storm they know is coming. Now, I want to explain something important. Understanding these vulnerabilities doesn't mean you should panic. It means you're now armed with the same information that Wall Street executives use to protect their own wealth. And there are specific steps you can take right now to not only protect yourself from what's coming but potentially profit significantly from it. Before I get to those strategies, let me show you one more piece of evidence that confirms we're approaching a major market inflection point. It's something called the Buffett indicator, named after Warren Buffett, who called it the best single measure of where valuations stand at any given moment. The Buffett indicator is simply the total market capitalization of all U.S. stocks divided by GDP. Historically, when this ratio exceeds 120%, market returns over the subsequent decade are dismal, typically negative in real terms. Where does it stand right now? An unprecedented 188%, the highest level in American financial history, even exceeding the peak of the dot-com bubble. Buffett himself has been voting with his wallet. Berkshire Hathaway now holds a record $189 billion in cash, nearly half its total assets. This from the man who famously said his favorite holding period is forever. When someone who made his fortune being greedy when others are fearful is holding this much cash, it should tell you something about how overvalued he believes the market has become. But here's where it gets really interesting, and where the biggest opportunities lie for those who are properly positioned. Market crashes don't affect all sectors equally. In fact, during previous major downturns, certain sectors and investment strategies not only survived but thrived. And based on the specific vulnerabilities I've outlined, we can identify with high confidence which areas will likely see the biggest losses and which might actually benefit from the coming instability. Remember, every major market dislocation creates both tremendous risk and extraordinary opportunity. The key is understanding where each exists before the crash occurs, not after. Wall Street insiders are already positioning their personal portfolios for what's coming, shifting into specific defensive sectors, alternative assets, and targeted short positions that could deliver massive returns when the broader market declines. In fact, according to SEC filings from the last quarter, the proprietary trading desks of the 6 largest U.S. banks have increased their holdings of these crash-resistant assets by more than 300% compared to the previous year. Meanwhile, their public-facing research departments continue recommending conventional stock and bond allocations to retail investors. It's a playbook they've used before every major market crash: position themselves first, then let the public take the losses. Now let's talk about the specific distortions that are reaching breaking points in today's market, distortions that Wall Street understands but deliberately obscures from retail investors. These distortions aren't just academic concerns, they're structural imbalances that virtually guarantee a significant market correction. More importantly, they point us toward the exact investment strategies that will likely perform best when that correction finally arrives. So what specific steps should you be taking right now to protect your wealth and potentially profit from what's coming? Let me walk you through the exact playbook that smart money is following, strategies that have worked during previous market corrections and are particularly well suited for the unique vulnerabilities we're facing today. First, let's talk about portfolio protection. Contrary to conventional wisdom, going to 100% cash isn't necessarily the optimal strategy. Cash certainly provides stability, but it also guarantees loss of purchasing power in an inflationary environment. Instead, consider implementing a barbell strategy, combining defensive positions with carefully selected opportunistic investments. On the defensive side, consider allocating 30 to 40% of your portfolio to true safe haven assets. Treasury inflation-protected securities, or TIPS, offer government-backed protection against both market crashes and inflation. Series I savings bonds currently yield over 5% and are completely exempt from state and local taxes. For those with larger portfolios, Treasury bills in the 3 to 6 month duration range provide liquidity while still capturing relatively high short-term yields. Short-duration bond funds, those with average maturities under 2 years, represent another defensive option with minimal interest rate risk. Just be careful to avoid funds with exposure to corporate debt, particularly high-yield or junk bonds, which tend to correlate with equities during market stress. Gold and select commodities have historically performed well during periods of financial instability. Physical gold, gold ETFs, or even select gold mining companies, particularly those with strong balance sheets and low production costs, can serve as effective portfolio stabilizers. I'm not suggesting going all in on precious metals, but a 5 to 10% allocation can provide meaningful diversification benefits. Now, what about the equity portion of your portfolio? This is where most investors make catastrophic mistakes during market corrections. They either stay fully invested in growth stocks that get decimated, or they indiscriminately sell everything, missing the fact that certain sectors actually thrive during economic downturns. Consumer staples, utilities, and healthcare, particularly companies with strong balance sheets, low debt, and essential products, have historically outperformed during recessions. Companies like Procter & Gamble, Johnson & Johnson, and NextEra Energy provide essential goods and services that consumers buy regardless of economic conditions. They also typically offer above-average dividends that become increasingly attractive as stock prices fall. Value stocks with low price-to-earnings ratios and high free cash flow yields also tend to outperform during market corrections. Right now, certain energy, telecom, and insurance companies are trading at P/E ratios 50 to 60% below the broader market while generating substantial free cash flow. These companies may still decline during a major correction, but historically they've fallen far less than the overall market while recovering more quickly. For more sophisticated investors, there are ways to potentially profit directly from market declines without taking extraordinary risk. Inverse ETFs, which move in the opposite direction of their target index, can provide a straightforward hedge against market declines. For example, if you believe technology stocks are particularly vulnerable, an inverse NASDAQ ETF would increase in value as tech stocks fall. Put options, which give you the right to sell a stock or index at a predetermined price, can provide portfolio insurance with limited downside. Even a small allocation to carefully selected put options can offset significant losses in your core holdings. Just remember that options require more active management and should represent only a small portion of your overall strategy. Now, here's something Wall Street definitely isn't telling you. Once the correction unfolds, extraordinary buying opportunities will emerge. The best returns in stock market history have come from investing during periods of extreme pessimism. After the 2008 financial crisis, many quality stocks traded at their lowest valuations in decades. Investors who deployed capital strategically during that period saw returns of 300 to 500% over the subsequent decade. That's why maintaining liquidity, having cash available when others are desperate to sell, is so critically important. I recommend keeping 15 to 25% of your portfolio in highly liquid instruments that can be immediately deployed when genuine bargains appear. This isn't about timing the exact bottom, but rather being prepared to act when fear is at its peak and valuations return to historical norms. Looking beyond the immediate correction, I believe we're entering a fundamental regime change in financial markets. The era of ultra-low interest rates that propelled all assets higher simultaneously is likely behind us. The next decade will favor careful security selection, active management, and investment strategies that generate income rather than relying solely on capital appreciation. Specific sectors are likely to emerge as secular winners. Companies involved in reshoring manufacturing to America, critical infrastructure, energy security, and certain segments of healthcare could experience sustained growth even in an otherwise challenging economic environment. These are areas where both government policy and private capital are converging, creating potential opportunities regardless of broader market conditions. Remember, market corrections are normal and necessary. They clear excesses, reset valuations, and create the foundation for the next sustainable bull market. While they can be painful in the short term, they're ultimately regenerative for the financial system. The investors who suffer most are those who ignore the warning signs, remain overexposed to the most vulnerable sectors, and lack a strategic plan for navigating the downturn. I want to emphasize, nothing I've discussed today is about fearmongering or extreme predictions. It's about recognizing the reality that markets move in cycles, understanding where we are in the current cycle, and positioning yourself accordingly. Financial well-being isn't about chasing the highest possible returns in bull markets. It's about generating solid long-term results while avoiding devastating drawdowns that can derail your financial goals. The strategies I've outlined aren't about trying to perfectly time the market. They're about making thoughtful adjustments based on changing risk-reward dynamics. Even if the correction takes longer to materialize than I expect, these approaches still offer reasonable return potential with significantly reduced risk. Exactly the combination prudent investors should seek at this stage of the market cycle. I'd love to hear your thoughts on the vulnerabilities we've discussed today. Are you seeing signs of these issues in your own industry or investment portfolio? What steps are you taking to prepare for potential market turbulence? Drop your insights in the comments below. I read every comment and am genuinely interested in your perspective. If you found value in this analysis, please hit that like button so more people can discover this information. And if you want to stay ahead of market developments rather than reacting to them after the fact, consider subscribing to the channel and hitting the notification bell. I'm committed to providing substantive analysis that cuts through the noise and helps you make better financial decisions. Remember, financial markets will always experience periods of volatility and uncertainty. It's not about avoiding these realities but rather understanding them and using that knowledge to your advantage. With the right approach, even the most challenging market environments can become opportunities rather than threats. I'm confident that those who take prudent action now will look back on this period not with regret, but with the satisfaction of having successfully navigated one of the most consequential market transitions in recent history. Thanks for watching, and I'll see you in the next video.